panels. I would just highlight that you can see that there are cameras in the back of the room. So we are live streaming, which means everything is on the record because of those cameras, and there are reporters in the room as well. Now, this is a somewhat different event for the Federal Reserve. Normally what we do is we'll have academics in, and we'll talk about academic topics related to the economy. The discussants will normally be academics, and the comments will normally be academics. It's a very nerdy kind of thing that we do, and that would be a typical conference that the Federal Reserve puts on. This, by intent, is designed to be something different. It really is intended to be a bit of a listening tour, and I want to give you a little context to why we're trying to have a listening tour and trying to engage in a conversation over the course of this morning. So when I first came to the Federal Reserve, which was some time ago, you can tell from my gray hair, it was a very different Fed. We were primarily focused on money aggregates. We did not announce what decision we made at meetings. The chairs of the Fed prided themselves in not being clear as opposed to being clear, and transparency was not a goal. It was much more being like a Delphic oracle than it was trying to communicate in an interactive way with the public at large about what we were doing. Obviously, a lot's changed. We have press conferences after meetings. There's a lot of attention by the press as to what we're doing, why we're doing it, when we'll do it. It's even occurring just as I passed the TV screen this morning. So it is a very different environment we're in, but a lot of the discussion tends to be within the walls of the Federal Reserve. And I would say in central banks more generally, they've not engaged the public at large. And so this is a goal to actually try to have a much broader conversation about monetary policy than has normally occurred. So there are a couple people here from the Bank of Canada, and Bank of Canada was one of the first central banks that started to have a more regularized, every 5 years, they have a discussion of their framework. And they discuss things like communication and how concerned should they be about inflation versus unemployment. What are the trade-offs and what society should be comfortable with? What they hadn't done, at least up to date, was to really engage the public more broadly. And so this conference itself is intended to be part of that more broad engagement. And it's being done at all 12 reserve banks around the country. Now, each reserve bank's doing it slightly differently. So each one of these is a little bit of an experiment. We're hoping, though, that as we hear all these comments, we'll have a much better idea of how people are viewing the trade-off between inflation and unemployment, and how we should put that into the context of setting monetary policy. So over the course of this year, we're going to have these conferences. At the same time, we're going to have internal meetings trying to think about, do we have the right framework now? Are there adjustments that we can make that will result in better outcomes to the public? So I'm hoping over the course of this morning that you all feel comfortable in raising your voices, telling us what you think. It is a listening tour, so the goal is that we're going to be facilitating the discussion, but we're not meant to be dominating the discussion. So we're primarily here to listen from everybody who is composed in this audience. So I hope you all feel comfortable in engaging that conversation. And with that introduction, I'm going to turn it over to Rich Clarida, who's going to give some opening remarks. He's the vice chair of the Board of Governors. He woke up very early this morning to get up here in time for the conference. And so, Rich, the floor is yours.
Thank you very much, Eric, and I am looking forward to this event. I'm very much pleased to attend this event here. As we're listening, part of our review of our framework to think about our monetary policy strategies, tools, and communications practices. I should say we're bringing open minds to our review, and we're seeking a broad range of perspectives. To the Federal Reserve, it simply seems like good institutional practice to engage with a wide range of interested individuals and groups as part of our approach to enhance transparency and accountability. Importantly, the U.S. Congress did charge and has charged the Federal Reserve with achieving a dual mandate, maximum employment and price stability, and this review will take this mandate as a given. We will also take as given that a 2% rate of inflation is the operational goal most consistent with our price stability mandate. While we believe that our existing strategies, tools, and communications practices have generally served the public well, we are eager to evaluate ways that they might be improved. That said, based on the experience of other central banks that have undertaken similar reviews, our review is more likely to produce an evolution, not a revolution, in the way we conduct monetary policy. With the U.S. economy operating at or close to our maximum employment and price stability goals, now is an especially opportune time for this review. The unemployment rate is at a 50-year low, and inflation is running close to our 2% objective. We want to ensure that we continue to meet our statutory goals in coming years. In addition, we will evaluate new policy tools and enhanced communication practices that the Fed deployed in response to the Great Recession. Furthermore, the U.S. and foreign economies have evolved significantly since before the crisis. Perhaps most importantly, neutral interest rates appear to have fallen in the U.S. and abroad. This global decline in neutral interest rates is widely expected to persist for years and likely reflects several factors, including aging populations, changes in risk-taking behavior, and slowdown in productivity growth. These factors' contributions are highly uncertain, but irrespective of the precise role, the policy implications of a decline in neutral interest rates are very important because, all else equal, a fall in neutral rates increases the likelihood that a central bank's policy rate will reach the effective lower bound in future economic downturns. That development in turn can make it more difficult during downturns for monetary policy to support household spending, investment, and employment and keep inflation from falling too low. Another key development in recent decades is that inflation appears to be less responsive to resource slack, implying a change in the dynamic relation between inflation and employment. This change is, in a sense, a double-edged sword because it permits the Fed to support employment more aggressively during a downturn. However, that dynamic also increases the cost in terms of economic output of reversing any unwelcome increase in longer-run inflation expectations. Thus, it is all the more important that longer-run inflation expectations remain anchored at levels consistent with our 2% inflation objectives. The monetary policy review will have several components. As Eric mentioned, we're going to be hosting, or the reserve banks will be hosting, a dozen Fed Listens events this year. Next month, the Federal Reserve System is holding a research conference at the Federal Reserve Bank of Chicago with speakers and panelists from outside the Fed. Building on the perspectives that we hear and on our own staff's analysis, the Federal Open Market Committee, comprised of the 12 Reserve Bank presidents and the Board of Governors, will perform its own assessment of how we conduct policy beginning around the middle of this year. We expect to make our conclusions public in the first half of 2020. So in conclusion, the economy is constantly evolving, bringing with it new policy challenges. It makes sense for us to remain open-minded as we assess current practice and consider ideas that could potentially enhance our ability to deliver on the goals that the Congress has assigned to us. For this reason, my colleagues and I do not want to preempt or to predict our ultimate findings. What I can say is that any changes to our conduct of policy that we might make will be aimed solely at improving our ability to achieve and sustain our dual mandate objectives in the world we live in today. Thank you very much.
Thank you. Well, good morning, everybody. It's nice to see all these familiar faces. Some of you have met on the phone. Many of you have met in person. My job this morning is just to provide a little more context for the discussion we'll have today. I want to talk about three things. One is, how do we actually do monetary policy, but in relatively straightforward terms? Why is today a good time to be thinking about how we do policy? And then third, I just want to make the connection between that discussion and the discussion we'll have today and what sorts of questions we'll be thinking about as we move into our discussion today. And there's time both for our panelists and everybody in the audience to chip in. So if you have a question about monetary policy, this is your chance. This is your chance. Or an observation, something we need to know. This is the time you get to talk to us So I hope you take that, they take that seriously. I want to start with just a really simple chart that will explain for you visually exactly how monetary policy works. It's a very simple diagram. You can see the important role of the flux capacitor. Anybody remember where the flux capacitor is from? Yes, thank you. So it's an illusion. For those who are less visually oriented, this set of equations should make it clear exactly how we do things. Okay, so I'm kidding, but this chart is, I hope, a simple chart, talking about how the Fed actually affects the things that it cares about. So Vice Chair Clarida talked about the dual mandate. We're responsible for two things in monetary policy. One is trying to get maximum sustainable employment, and by that we mean as much employment as you can get without interfering with our second mandate, which is low and stable inflation. We call it price stability, but it's really low and stable inflation. So how do we do that? Well, we start by setting one particular interest rate, really, in normal times. It's a rate that is short-term. It's a rate that financial institutions borrow and lend among each other. That's what that thing is. So we can set that, and we control it quite tightly. Now, if that was the only thing we did, the Fed would not be in the Wall Street Journal. No one would be paying attention to us. It just wouldn't be very interesting. But of course, the fact is that when we set that interest rate, it affects lots of other interest rates that you all know about, interest rates that are much more directly related to real activity from households and from businesses. So those are things like interest rates on mortgages, business loans, auto loans, all sorts of things. Okay, so that's the first link in the chain, if you will. So from that one rate we control to a bunch of other interest rates that really affect real activity. So then in turn, those are going to affect spending. Folks who depend in part on borrowing to finance their spending, that includes both households and businesses. They're spending on houses, cars, large ticket items like that, but also businesses often borrow for capital equipment and so on. So by affecting those longer term interest rates, we're going to have an effect on spending among households and businesses. And then in turn, that's going to affect how many people businesses want to hire. The more demand there is for stuff, for cars, houses, goods, and so on, the more they're going to hire. So there's the employment chain. And then I reiterated the piece of the dual mandate there, the maximum sustainable employment piece. You can see there, we're starting to affect that. And then at some point, maximum sustainable employment is good if you go a little beyond that. If you start to stretch the economy a little bit too far, you might affect inflation. Conversely, if there are not enough people employed and lots of people looking for work, we call that economic slack, that's going to tend to pull inflation down. So we're trying to balance all of those two things, those two elements of our dual mandate. So that's kind of the way we do it. It starts with that very specific interest rate, links through a bunch of other really important interest rates that are tied to spending, which in turn is tied to employment, part of our dual mandate, and that's tied to inflation. So there are the two pieces, the dual mandate there on the right, which we're ultimately trying to get the best possible outcomes for. I just want to emphasize as well that those arrows I just drew in, the computer drew them in, but in any event, those two arrows that go backwards show you that what we're doing is we're looking at inflation and we're looking at employment and labor markets to see if they are near the goals that Congress has given us. And when we're not, that's feeding back into the setting of the interest rate that we control to then try and get us closer to those goals. So that's monetary policy in one simple chart, I hope. That's what we're doing. Now, importantly, a bunch of these things are going to link into our discussion today. What I want to turn to for just a moment is why is today a time when we'd be thinking about our monetary policy framework? And Vice Chair Clarida highlighted a couple of things. I want to just drill in a little bit more on one of those, which is that we're currently in a fairly low interest rate environment. And the Vice Chair talked about why that might be true. What I want to discuss is why is that a challenge for us? Why is a low interest rate environment a challenge? Okay, so here's a little chart that talks about what we do to respond to recessions. So you're going to see in a second a couple of lines. One says, what do interest rates look like when the economy is doing well? And then what happens as we respond to the recession? So the historical average is this first green line. We moved from some higher interest rate. Here it's just stylistically at 6%. And we move it down to 1%. Now, although the actual levels are just sort of a cartoon, the change there is important. It reflects the fact that on average, we lower interest rates by about 5 percentage points when a recession occurs. That seems to be enough on average to offset much of the effects of a recession over time. Okay, so that's what we do. We lower interest rates, we lower them by about that much. Today, we're starting at an interest rate, as of today, that one interest rate we control is at 2.4%. And what that implies is, should we face a recession sometime in the coming years, we would have about 2.4 percentage points to lower it. At that point, we hit zero. really hard to make interest rates go much below zero for reasons we can talk about over coffee. But that is the limit that we're facing. So for that reason, what happens in that case? Well, I'm reprising the two left-hand boxes from the previous chart, right? The first two parts of this, these linkages between what the Fed does and what happens in the economy. So suppose you don't have anymore the option of moving that short-term interest rate anymore, right? Because you've hit the lower bound, you hit zero. Okay, so that's ruled out. What can you do? Well, this is what we want to think about. Here's a couple of options I just want to preview quickly. One is you can think about trying to operate directly on those important long-term interest rates. So we did some of this during the financial crisis and the Great Recession. We actually purchased assets that are related to these interest rates so as to lower their rates directly. Rather than waiting for the financial markets to percolate through that particular short-term interest rate we control, we worked in those markets to directly affect the longer-term interest rates that we know are more directly related to spending and to employment. So we could do more of that. And another thing we could do, if you look to the left there, what we can do is think about ways to create a little bit more operating room. So right now we have 2.4 percentage points by which we could reduce our policy rate. Well, there are things we could think about that might actually give us a little bit more cushion. We're not going to get into all those today. But anyway, that's the reason we're worried about a low interest rate environment. It constrains us to some extent. And we're thinking about some options that might give us more purchase over the economy when we need that, should we be hit by a recession. All right. So what we want to talk about today is in that set of linkages between what policy does and what happens in the economy is how do those large features, the aggregate features of the economy, affect you? How do they affect you and the groups that you represent? So the key questions we want to talk about today are, for starters, how have and how do overall labor market conditions affect you and the populations you work with or live with? And so that's interesting for today because, as Governor Vice Chair Clarida said, we're in what we'd call a tight labor market. Unemployment's pretty low. It is relatively easy to find jobs. That's probably a good thing for most people in the room, but we want to hear from all of the perspectives represented here, how that affects you. But also to think about during the 2007 to 2009 financial crisis and Great Recession, when the Fed was working, we think, mightily to offset it. How did those labor market conditions affect you? We have some idea about that, but we would like to hear your perspective on that. And maybe also, do you feel that the Fed was effective in mitigating the effects of that recession on labor markets during that period? So that's one set of questions we'll talk about. The second is, as was obvious from that simple chart, not the first one, but the second simple chart I showed you, we work on the economy largely by affecting interest rates. So as a matter of course, when we're conducting policy, trying to hit our congressionally mandated goals, we move interest rates up and down. That percolates through the markets. That affects rates that affect you when you need to borrow and also when you need to save. Both of those matter. So just a question we'll be talking about is how much do lower and higher interest rates affect you? They are somewhat low today. They were really low. They were essentially at zero during the Great Recession. So how do those interest rate fluctuations affect you and the communities that you represent? So that'll be another set of questions. And finally, we can't leave as a central bank without talking about inflation. How does inflation affect you? Now, in the 1970s and early 1980s, for those of you who remember this period, inflation was really high and quite variable as well, and probably was much more present to the average person living in the US than it might be today, because fortunately, because of a long sequence of monetary policy actions, we have relatively low and stable inflation. So we're hoping that is not a first order concern to you, that the fact that we keep it low and stable, you don't need to worry about it by and large. However, we might still discuss a little bit, the inflation were a little bit higher or a little bit lower, how might that affect the populations that you work with? So that's the framework. It's why we are talking about it today, and then some of the questions that we will discuss during the rest of today's convening that will make the connection between what we do and what you experience with your communities. So with that, I think we can move on to the next panel, the first panel, actually. Right? Okay.
You're right, Jeff.
Yeah.
Thank you. Thank you all for coming, and I wanted just to say for myself, I'm very happy to be taking part in this morning's conversation. My name is Jeff Thompson. I'm an economist here at the bank, and I'm also the director of the New England Public Policy Center. And the center is focused on regional, economic, and policy issues. And we do research that tries to speak to important public policy issues that the region faces. So, for example, in recent years and months, we focused on issues like housing affordability, the impacts of the opioid crisis, et cetera. So I think it's a nice pairing of myself with the panelists this morning, who all, in one way or another, represent and work with low-income communities around the New England region. And I will briefly introduce them, just sort of name, organization, title, and then hand it over to them. We'll each take a couple of minutes to give a little bit more background on their organization and the groups that they work with. And then we'll dive into a handful of questions that sort of get at what Jeff just framed as the conversation for today. So immediately to my left, Rachel Pflum. Rachel is the executive director of the Economic Progress Institute in Rhode Island. Elise Cherry is the CEO of Blue Hub Capital. Aaron Gornstein, president and CEO of Preservation of Affordable Housing here in Boston. And finally, Carlene Porcena, who is an Economic Opportunity Program Officer at the Local Initiatives Support Corporation. So thank you all for joining us, and I'll go ahead and hand it off to Rachel.
Thank you, Jeff, and thank you for having me here today. Again, I'm Rachel Pflum. I'm the Executive Director of the Economic Progress Institute in Rhode Island. We're a small nonprofit research and advocacy organization that works to improve economic security for all Rhode Islanders. We're part of a national network of the State Priorities Partnership, which is organized through the Center on Budget and Policy Priorities, and also part of the Economic Policy Institute in DC's EARN network. So we really focus on both improving wages. We look at tax and budget policy from a low income perspective, and then we have a legislative agenda around improving both work support programs for lower income folks as well as wages and other things.
Well, thanks very much, Jeff. I appreciate it. And thanks to the Boston Fed and the Fed writ large. I think this is a great conversation to be having. As Jeff said, I'm Elise Cherry. I'm CEO of Blue Hub Capital. Some of you may know us in our former incarnation as Boston Community Capital, but we've become a national organization over many years, and really I was tired of going to places like Kansas City and explaining we weren't a local microlender. So what we do is we really exist to help build healthy communities where low-income people live and work. A lot of that is around economic integration, as opposed to putting more affordable housing, say, into low-income communities. We're happy to spread it all over the place so that everybody has the benefits of living in a more economically integrated way. We, by now, have put out about $2 billion. We've leveraged another $9 billion, and those monies go toward things like schools and affordable housing and community facilities like daycare centers and charter schools and grocery stores, healthcare centers, assisted living and such. We do a lot of affordable housing work. We have a foreclosure relief undertaking that's managed to stabilize better than 1,000 families in 7 states. And we play a big policy role on the housing side, and particularly with respect to solar policy and the idea of assuring that low-income communities and populations have access to all of the kinds of energy resiliency that is important for all of us.
Thank you. My name is Aaron Gornstein. I'm with POA, Preservation of Affordable Housing. We're a national nonprofit organization based here in Boston. We own and manage about 11,000 affordable apartments across the country in 11 states and the District of Columbia. Most of that is in New England, in particular in Massachusetts, where we own about 5,500 apartments. One of the things we've been doing at POA in recent years is to strive to utilize our communities as a platform for resident success. What can we do for our residents around education, around getting jobs, financial stability, community engagement, and health? Those are the key areas we want to work with our residents. And for the purposes this morning, I want to talk more about economic mobility and how that fits into the questions that were asked. But the way we do that is really by entering into partnerships with local community-based organizations where our properties are located to help deliver the services to our residents. So that's what we're about. And I'm also excited about the fact that we're starting to collect a lot of data about our resident needs. What do they want? What kinds of programming are they interested in? How can we engage them to get to the next step?
Good morning, everyone. I'm Carlene Porcena. I'm the Senior Officer for Economic Development at the Local Initiative Support Corporation. Thank you for having me here today. So LISC, for those of you who don't know, is a national CDC. We work in over 30 different cities across the country, and we also have a rural footprint. So when you think about policies and you think about the geographies and how different communities are impacted, it's really important to not think about like hyper urban markets as well. So that's really helpful to kind of have that broad understanding. The work that I do primarily focuses on economic development, but LISC has been known for supporting CDC through affordable housing, of course. I primarily focus on workforce development and thinking about not just jobs, but good jobs, and how do we make sure that people have access to jobs where there's some kind of career pathway. And in addition to that, entrepreneurship. So we tend to think about wealth building primarily as buying a home. And in a housing market like Boston, that's nearly impossible right now. But thinking about entrepreneurship as a means to wealth building has been a really big kind of goal of the LISC Boston office. And I think the other thing too, there's been a lot of connections with a lot of the health and anchor institutions across the country, thinking about how do we impact communities through kind of public-private partnerships. So happy to talk a little bit about what we do throughout this morning.
Wonderful. Thank you all. And we'll go ahead and start off by tackling one of the core elements that all three previous speakers, Vice Chair Claret, President Rosinger, and Jeff Fuhrer already mentioned, the fact that labor markets presently are very tight. Nationally, the number was already thrown out there, 3.6%. Here in New England, it's even lower, 3.2%. Despite very tight market conditions, we also know that not everyone has benefited equally from a tight labor market. We know that there are regions, even within New England, there are regions that feel like they've been left behind. We also know that important and troubling racial differences in well-being remain. In the face of those factors of the economy that we now have, I'd love to get some comments from each of you about both the benefits and the costs from maintaining markets as tight as they are now, or even considering policy maneuvers to push unemployment even lower. So what do we see as the benefits and the costs of this tight market for the communities that you work with? Why don't you start? We'll start with Carlene.
So, I mean, when I think about the unemployment rate, it's also really important to think about which communities we're referring to. Because when you look at low-income communities and communities of color, they tend to have even higher unemployment rates as opposed to thinking about it from a national lens. One of the things that I also think about is underemployment. We tend to think just because people have a job that is sound, but when you're working in communities like Boston where the cost of living is so high, it's really important to think about what does a good job actually mean. It's not just about having a job, it's about having a job that has benefits. What are the hours? What are the treatments of the individuals? So for us, a tight market, you have to look at how does it impact the actual, the different types of communities. The other thing too is thinking about people who don't have access to all of these jobs. I mean, we have so many different industries here, finance, education, health, but you think about populations that have been Corey involved. I mean, it's nearly impossible to get a job if you have any kind of criminal history, and that's extremely challenging, especially for some of our financial opportunity centers. So we have a network of FOCs across the country, over 90 of them that work with individuals and help them find jobs. But if you have these barriers and these systems that are keeping you from having a job, what do you do in those times?
Should I go next? Okay. So we have 18,000 low-income residents living in our properties around the country. The average income is about $15,000 a year. And so the tight labor market has certainly meant that many residents are able to access jobs now that they previously could not. So that's a very good thing. What we do, just picking up on the barriers, what we're observing is the high cost of childcare and transportation, huge impact on the ability of our residents to obtain employment. And then the other issue is once they've gotten a job, to retain that job. So we've realized that we have to focus a lot more with our partners on job retention and promotion so that people can succeed, not just in first getting the job, but in maintaining it. We also believe very strongly on the power and impact of financial coaching. And I know LISC is huge here with their financial opportunity centers. To be able to provide high quality financial coaching to our residents makes all the difference in the world. So that prepares them for the job, but then on an ongoing basis to ensure they're looking at debt, and there's a lot of student debt out there that's getting in the way, in increasing their credit scores. These are all the kinds of things and monthly budgeting that are needed in order to succeed in employment. So it's not just that it may be easier to get a job, but let's look at all the other issues that people are facing of low income. And those are some of the things that we're seeing right now.
So when I think about all of this, I really think about it from some different frameworks. One is the impact direct on the people we're talking about, or is it derivative, meaning that it actually impacts the employers and that kind of comes down to the folks who are employed? Two is we're not talking about a monolithic population by a long shot, right? So some folks that we're talking about might work at a large hospital and have relatively regularly scheduled work, but others, for example, say somebody in one of the immigrant communities in our gateway cities here in Massachusetts, which is really the engine for the state in many respects with respect to the economy, that person might be deciding to set up a new restaurant, say. So they've taken the money they've earned both from a job and maybe working for Uber and maybe delivering packages from Amazon, and they're scraping together enough money to get some secondhand restaurant equipment, and then they're in the hiring role. Right. So that in that circumstance, they're saying, well, a tight labor market makes it much more difficult for me to actually get the help that I need. On the other hand, if it's somebody coming in as a server or as a cook into that establishment, they're happy about a tighter labor market because it gives them more opportunity and perhaps the opportunity to negotiate for higher wages. So part of what I guess I'm saying is that in many respects, what happens in low-income communities really mirrors what happens in the rest of the population. If prices go up, it's good for the companies who perhaps make a higher profit margin, and maybe that goes out and eventually gets to higher wages, but it's hard for the consumers who are then having to use more money. And so I think in all of this, we really have to look much more in a much more granular fashion at the communities that we're talking about. All low-income folks don't work for large employers. Often people are putting together bits of jobs. People will talk about pieces of money, right? I got a piece from driving an Uber. I have a piece from a job that gives me some hours but is not necessarily consistent. Maybe I'm doing something else. Maybe I'm renting out a room in my home. And so the impact on all of these things of both inflation and interest rate can be different depending. If I'm trying, for example, to get a loan for that restaurant equipment or a loan for a truck, then I'm really impacted in a different way than I would be if I were an individual. And then the final thing I would say, and I think these themes keep coming up throughout all these questions, is really time frame. So if we're looking simply at employment today, it's one cut. But one of the challenges about a tight labor market and potentially increasing wages, although I'm all for folks being able to make some more money here. But the challenge is if I'm running a substantial company, I then start saying, well, wait a minute, if it's going to cost me more to employ folks, what do I do to reduce my headcount, right? And so that pushes us much more toward AI solutions and much more toward robotic solutions. And so when I think about employment, and particularly the Fed's mandate with respect to maintaining full employment, my concern is not just for today, but really for 3 years and 5 years and 10 years from now, and what it is that we're doing either through the Fed or as a culture, as a country, to assure that people have the skills they need to be able to move into the kinds of jobs that may emerge, or in fact, if the need for people just goes down as a general matter, how we deal with the fact that people will be working fewer hours, and also how we deal with the issues around meaning and purpose in people's lives if they're not getting up every day and going to work. So I guess that's how I would respond to this. I think it's this sort of matrix of both time and role that people play within the economies in which they're functioning.
So I think I would start by saying that I would like to push back a little bit on this argument that labor markets are tight. I mean, as has been said, I'm not sure that that's true for everyone across the board. We recently did a study that looked at status of women of color in our state, and what we found is that if you compare pre-recession and post-recession wages, that for white women and for Latino women even, they had increased their wages past where they had been pre-recession. But for black women, they had not. They were lagging behind still. So I think there still is a real question about nominal wage growth and whether we are where we need to be in order to continue to address these disparities. Certainly tight labor markets are good. They ensure that workers have good jobs with good benefits and that they, bless you, are able to, that employers are able to do or feel like they need to do sort of the workforce development pieces that need to be done. And so we would really push that the tighter the labor market can get over a sustained period of time, the better in addressing these disparities. Because if you look at the racially based employment gaps and then also gaps in terms of household hours worked, which are a big piece in ensuring that people come up out of poverty and can move up their economic sustainability, it really is very important that the labor market remain as tight as possible for as long as possible.
Thank you. So sort of keying off of Rachel's final comment there, the value of maintaining unemployment as low as possible for as long as possible, but also knowing that the system, the Fed system, has a dual mandate, price stability and maximum employment. I would love to get comments from each of you regarding your sense about the relative priority of the two mandates. Does one stand out as paramount? How should, in terms of the communities that you work in, how should we think about the potential trade-offs that our two core mandates face? So I'd love to hear your thoughts and comments. Do reverse order this time.
So I think it's fairly obvious where I stand on this. We really think that the benefits of a prolonged, progressive, sustained period of tight labor markets outweighs the inflationary costs, especially right now where we haven't seen those going up. And so until we get to a point where that is an issue and needs to be addressed, then we can look at that further. But we really feel like the best place to start with this and to continue this is to keep the labor market as tight as possible. I would argue that in addition to the two goals that the Fed has, that we really think that for lower income folks and for workers of color, it is very important for the Fed also to step into the role of helping boost the economy by encouraging Congress to act in a way that stimulates the economy as well. And I know that can be a political quandary to step into, but just to encourage that there needs to be other things just than what the Fed can do. So trying to think about what the bully pulpit is that the Fed can have on that, because you can't do this alone as we go into the next recession, and certainly you have not been helped for the last few years by what states and the federal government has done in terms of austerity measures. So certainly to the extent we can encourage you to step beyond your usual comfort zone on that, I would like to do so.
Well, I suppose the classic view really with respect to inflation and low-income communities is that the higher inflation, the more adverse and disproportionate the impact is on the lowest income people in our populations, to the extent that people are engaging in a cash economy. Every time inflation goes up, the value of their cash goes down. And so it's very negative. And we see this sometimes in the developing world, in which we have inflation well above our 2% target. I mean, when we're at 2%, I'm not really sure it makes all that much of a difference. 1%, 2%, 3%, prices are pretty stable. So I think it has less of an impact today. But again, I also think it goes to the heart of this question about who really are the folks that we're talking about in low-income populations and communities, and how is it that we help people emerge from poverty, and how is it that we help the entrepreneurial undertakings that really help people get there. And so when we're talking about that, I think maybe interest rate can be a little bit more important, and that people are sometimes benefited from slightly more inflation as they can charge higher prices and so forth. But in general, I think low-income populations and communities, just like everybody else, really benefit from a strong economy. I mean, poor people generally are the first fired and the last hired, and so recessions for low-income populations tend to last longer and to be deeper. And so in some respects, for the Fed to maintain stability both on the interest rate side and on the pricing side really benefits the communities we serve, even though one could argue that the entrepreneurial parts of that community are more benefited by lower interest rates and perhaps less benefited by sustaining price stability.
Well, I would just point out that while the inflation rate overall is very low, I think it's 2.5% CPI. If you're waiting for affordable housing, if you're on one of the millions of families on the waiting list somewhere, or you're living in unsubsidized market rate housing, the cost increase are a lot higher than 2.5%. We have record numbers of severely cost-burdened households, renter households, living in many areas, particularly here in Greater Boston, but in other parts of New England. So I think it's important to keep that in mind, that actually many low-income families are experiencing a lot higher inflation costs in certain areas, particularly when it comes to housing costs. But also, as I mentioned before, childcare is very expensive, and transportation, and you add all those up, and people are, while they may be gainfully employed, or even having 2 minimum wage jobs, it's not enough to live in some of the higher cost regions of New England, or higher cost communities in New England. So just important to keep, and I don't know the answer of which one you push on more. I just know that, as Lee said, low-income people are much more impacted and price sensitive for many of the costs that we don't necessarily think about automatically. So.
Yeah, I would agree. I think that the focus on employment is key, especially with the communities that we work with. In the presentation earlier, we saw looking at employment right after the recession, and at this time I was working doing direct services, and I'll never forget. I remember doing SNAP benefits for an individual who had his master's degree, and I was thinking, wow, how do we think about helping people who are very low income, very low educated, and they're getting the exact same benefits as someone who has a huge education, is on the right path. So I know she had mentioned thinking about low income as a broad spectrum. We tend to think about low income as like one type of person, but there's so much variety within, the low income bucket. One of our partners in East Boston I was talking to the other day said they now have people who are working full time but are actually homeless. Can you imagine working full time and not having enough to even sustain the cost of living in just East Boston, a neighborhood that has historically been really affordable? That's the same kind of conversation that's happening in Roxbury. From 2010 to 2015, there was a 70% increase in the cost of living in Roxbury, just Roxbury alone. So when I think about how it impacts actual people, I really think that we have to think about good jobs. It's not just about finding a job. You talked about retention. the role of the financial coach and the model that we have around financial opportunity centers is really thinking about how do you budget, and the funny thing is people tend to think low-income people don't budget. They actually are very resourceful, right? Like if you have a minimal income, you know exactly how much things cost and you know exactly how much you have to spend. I can't tell you how many times I've done taxes for people and they knew exactly to the T what the expenses were for their taxes. So all that to say, jobs are extremely important, but it's not just jobs. It's good jobs. It's jobs that have good wages and have some kind of career pathway.
Thank you. So in her answer to the previous question, Elise mentioned a few instances give a few examples of how consumers and people in the population respond to and interact with interest rates, whether it's needing to borrow a business loan or buy a car. So we know that interest rates affect people's decisions and well-being. But in addition to borrowing, interest rates also influence the rate of return on some people's savings, bank accounts. So I'd love to hear some thoughts from each of you about how keeping rates as low as they currently are, and not with inflation and not with employment, but focusing specifically on our primary tool, raising and lowering interest rates. So how does the current low rate environment and also maybe how the prospect of potential increases in interest rates to get the system back to more of something closer to its long run normal posture, how that affects people in your community and how you think about that in terms of working with your communities? Starting again with Carlene.
So I think about interest rates, I think primarily around small businesses. Many of the small businesses and entrepreneurs that we work with aren't able to get financial loans through kind of traditional banking institutions. So they're left to online lenders, a lot of predatory lenders. And when you look at specific neighborhoods, they're over flooded with these check cashers places. You would never go into a Lexington, Brookline, Wellesley and see these places, right? So it's like thinking about access to certain products and how they're positioned in certain communities because it's easy access. We've had loans that we've done with people who have had interest rates and all these kind of crazy policies that really kind of continue to increase the debt of individuals. And then, you spoke about credit scores. Boston has a third of the population in Boston has either low or poor credit. If you think about a city that has such great resources, a third of the population here still is in so much debt. The Fed also did a research report, I think it was last year or the year before, that looked at debt and collections in certain neighborhoods. And for me, I think interest rates, that's where it relates to, right? It ties directly into debt and what's holding people from really having any kind of economic mobility. So when you think about borrowing and how it impacts individuals who don't have a safety net and have to borrow, especially in times of emergency, that debt just becomes greater, greater, and greater. And then when you have an opportunity to potentially buy a home, you're left out of that equation as well.
Yeah, so picking up on the home ownership issue, obviously lower interest rates are so critical for home ownership. And home ownership is critical for the economy. What we're seeing is people, even with the low interest rates, locked out of home ownership, which is very concerning. And we need to focus on transitioning people from rental housing into home ownership as best we possibly can. And if you don't have low interest rates, it makes it very, very difficult. So one of the things I wanted to mention that we're really working on, and I mentioned economic mobility of our residents, is encouraging them to save, to look at their credit scores, to get good financial coaching, to decrease their debt, and to, as their income goes up in assisted housing, instead of their rent going up, we're utilizing a program called the Family Self-Sufficiency Program and putting that earnings into a savings. And that is then building up over time. And we've seen significant income gains in a very short period of time. I think is an incredibly promising model that we should expand nationwide to every resident of assisted housing. It takes away the disincentive to grow one's income. I'm bringing it back to home ownership because those same residents desire home ownership. And they can do it in some areas if given the tools. So I think that's one thing. And then the other piece I wanted to mention about interest rates is just from a housing developer standpoint, that makes it critical to be able to build more affordable housing and keep the interest rates low. Interest rates go up, it's going to impinge on our ability to produce more affordable housing. We're seeing the business community really calling attention to the issue that we need much more housing production in Massachusetts, as well as the governor's talking about it. And so we have to look at, especially with the tight labor markets, the sharp increase in construction costs, both labor and supplies. And then on top of that, if you're going to increase interest rates, it's going to make it extremely difficult to get more affordable housing built, which is what we desperately need going forward.
So when I think about this, I think not only about folks who are at or close to the poverty line, but also what are the routes for people to come out of poverty. And the two areas I think about in particular are community colleges, which really wind up in some ways being the engine of the economy, right? And then again, entrepreneurial activities. And for both of those things, in order to afford community college and in order to afford to begin to build even the smallest kind of business, credit is really key. And so to the extent that interest rates rise, I think both of those areas become less available to people trying to pull themselves out of their difficult economic circumstances. The other thing I'll say, for years and years and years, we were essentially a business-to-business undertaking. We would work with community development corporations or hospitals or schools or small developers or something. Then we began to do our foreclosure work, and all of a sudden we became a business-to-consumer organization, or at least have that line. And it's a very different experience. And at this point, we have now interviewed and assessed the financial ability of hundreds and hundreds and hundreds of mortgage applicants. And so we've come to understand a whole lot about what the finances of a family looks like that actually were able to buy a home and then went through foreclosure and now is getting stable enough to come back out the other side. And the challenge, I think, is the issue about poverty is, it's not a moral issue. There's not enough money in the month, right? That's really the issue. And so trying to save in that period of time while you're also trying to pay a mortgage and pay insurance and pay taxes and pay the water bill and get your kids through school is really, really, really difficult. And so I guess what I wind up thinking about this is on the debt side, if you are invested in the economy at all, either because you have education loans or because you have housing loans, then you are substantially benefited, certainly in the short term, by lower interest rates. Again, the issue that I would include here, though, is if we look out 3 or 5 or 10 years, I think it's equally important to think about what the longer term impact is of short-term interest rates.
So I think I would agree with that. I think what we are finding is that post the last recession, people still, well, first of all, they had huge loss of wealth, right? So, and in terms of thinking about how to rebuild that wealth, what is the right interest rate level for folks, right? Because it's hard to save and recoup that wealth over a longer period of time if you have such small interest rates. On the other hand, we also know that people do have large debt, right? Those student loan debts, mortgage debts, and other things. And so I think this is a really a tricky one for lower income households to figure out what the right level is. But I would encourage us to think about both sides of that equation in that, we know that our families do not have enough savings, especially workers of color do not have the wealth that other families have. And so how does that balance with the need to also have enough capital to take out more debt? So I don't know what the answer is, unfortunately, but those are some of the things that I think about when thinking about this question.
Thank you. And I want to preface this next question by reassuring you all that we have thick skins and we can take it. But I wouldn't want to pose to you, knowing that we've laid out that the system has this dual mandate, I'd love to hear your thoughts about how the Fed system has performed in recent years over the past decade at achieving the components of the dual mandate.
Sure. So we think the Fed has been doing the right thing. They're trying to increase spending and boost the economy. As I said earlier, I think that you've been held back by Congress and state governments, really not helping you along in that. And I think that you really, at some point, the Fed felt that they needed to give in and increase rates fairly prematurely. So we would hope that going forward, you can keep that inclination in check and try to keep the rates low. Increase unemployment, even if it means the rates have to go a little bit higher than your target for a period of time. And again, I would urge you to try to do more in terms of trying to push for genuine full employment, looking at things like whether the women's labor force participation is at full capacity as indications of how we're doing. As others have said, things like childcare and other issues that families face impact those kinds of entry levels for folks into the economy. And so thinking about that in addition to just what the market looks like, I think is really important. And then again, focusing on ensuring that the underemployment rate for communities of color and the unemployment gap for especially Black citizens is made up is an important piece of this puzzle as well.
Well, I think this is an area in which I would say, Monday morning quarterbacking is a great sport, right? And we're all fairly certain we could have done better than at whatever point things went awry. But, I think that the challenge, and this particularly I think is true with respect to the most recent financial crisis, the Great Recession, is that there are other things going on in the world, right? Except in addition to inflation and interest, that part of what was happening, I think, through that period was a real reset in how economies work. And I think that everybody is now trying to figure that out and figure out the impact of interest rate and inflation on it. And in some respects, I think that we are in uncharted territory. So, what we get is, in the long run, is the benefit of a look back. Did you do it right or didn't you do it right? But I think it's pretty hard to predict going forward. In general, particularly because of the political pressures to have a good economy at this moment, we're often much more short-sighted than we should be in terms of the long-term impact of all of these things. And I think in some respects, we look to the Fed to take that longer-term impact so that we don't simply get the benefit today, but we actually have a benefit going forward. So in that respect, much as I like low interest rates today, and I certainly like stable inflation, I actually do worry about whether we have sufficient tools available for the next downturn. I mean, it seems to me that we have been late in the cycle for an awfully long time now, and I'm not one who believes that we're done with cycles. I remember back as a young attorney in the early 80s, I thought that anybody who had seen actually, we hit the early 90s and hit a really bad recession here. And I thought that anybody who had seen a prior recession was really old. I have to tell you, I don't think that anymore. But the fact is, it is a cyclical matter. And I do think that during good times, we really do have to prepare and to tee up for times that are bad, as opposed to simply saying it's great today, let's just keep it that way. So I think mine is a more cautionary view with respect to the longer term value of lower interest rates in particular.
Well, I think the Fed's done a good job at striking the right balance, and I think we've all said that in some way or another. What I want to take the opportunity to say, and I know this is strictly about monetary policy, how important the Fed's role is in engaging the community, like you're doing here this morning, in research, in public policy work, to kind of think ahead. And I think about, I've worked with the Fed my entire career in housing here in Boston, and the important role played during various points over the past 30 years, whether it's the foreclosure crisis and whether it's focusing on smaller cities or gateway cities in the Working Cities Challenge, the housing research that's done on a regular basis, the public policy work that you're in charge of. And I think just keeping that front and center as we go forward is so important. So I appreciate the president's role in housing over many years, and we're very grateful for that, as well as the Fed staff who've really, been open and transparent and engaging community-based organizations throughout the region, really. So I appreciate that.
I would definitely agree with that. I think that, we should think broadly about how you really impact the economy. And I think that the Fed's role as far as research and advocacy has definitely trickled down to the communities that we work with, thinking primarily about the Color of Wealth report, and some of the health statistics that came out, looking at the health disparities. For people who are doing this work, that information was not new, right? Like, we knew that, we understood that. But what the Feds did was, you all had the opportunity to bring those data points and that disparity to a much broader audience that a lot of the times nonprofits cannot do. We just don't have those connections. So as far as the role, I think continuing to do that type of research that really looks at what are the pain points of low-income communities, and making sure that you're leveraging the relationships and partners that you have to bring different people to the conversation.
Thank you. In a minute, we're winding down the first panel here, and I have one question I want to pose to the audience more generally. But before I do that, I want to give each of you panelists a minute or two if there's anything that we haven't touched on that you think would be important to get out there in terms of helping us understand this issue that we're grappling with, how we feel about the monetary policy framework moving forward, what changes do we need to make. So if there's anything that you didn't get out there, now's your chance. So we'll start with you, Carlene. Or you can defer. We can take it in turn. Okay. All right. You're all right? Elise?
I think the only thing that I would say, and the connection to monetary policy really is about interest rate and payment, that as we move forward, we need to turn into a culture in which we don't think about education as something that stops when you're 18 or 22, but something that really continues through the entire length of your life, so that you can continue to maintain the sorts of skills that will actually allow you to have a good job and potentially to emerge from poverty. And so the issues about how that's financed and what that looks like and how much impact interest rates have on that, I think, is something that I'm not sure the rest of the country is thinking about a whole lot. And I, take my hat off in particular to the Fed's research abilities, which have been really extraordinary over time. And when they're put to work, particularly in the populations that we look at, I think it's really, really helpful both to understand what's likely to happen to retail jobs, for example, driving jobs, and then really to think about the cost and the benefit to the economy of a lifelong learning approach and how that's financed and how interest rates really impact that over time.
All right, so everyone has had their say, and we have a few more minutes at least. So I have at least one question that I want to put out there. Earlier, I asked the panelists to comment on their sense about the relative, which of the two parts of the dual mandate, low on maximum employment and price stability, did they think was particularly more dominant? Which did they prioritize relative to their communities? And so I want to spin this a little bit more, because the consequences, we talked through the consequences of potentially overshooting the maximum sustainable employment level and accidentally engendering, driving up inflation. And so there really is a trade-off. And so I want to get, but also the consequences for households of not having a job when your family needs one, those are real as well. So if anyone out there wants to give their comments and thoughts about the relative strengths, the relative how we as a system should prioritize the two, or how the communities that you work with and engage in are impacted by the two, I'll hand the floor to you. Please.
Good afternoon.
Yeah, and so one of the key things, as you talk about the dual mandate, and which one should you prioritize, I think they go hand in hand. And so you can't really prioritize one over the other. And so as I kind of think about the comments that were here today, I think about, home ownership. And someone mentioned earlier about, it's not only about getting jobs, it's about keeping those jobs. Well, when it comes to home ownership as a key tool for wealth in this country, it's not just about buying the home, it's about being able to keep it. And if you don't have a good, stable job with wages that keep pace with or outpace inflation, then it's very hard to kind of keep a home. And so that then destroys your wealth. And we're seeing that happen in the gateway cities where property values have declined as much as 41% since the recession. And a lot of people don't have the resources to maintain their homes. And we're seeing a nationwide eviction crisis. So I would like to kind of hear a little bit more from the panelists, maybe a little bit about the intersectionality between jobs and wages and housing, and how the Fed might be able to kind of help kind of think about those three intersectionalities in a more kind of systemic way.
Anybody want to respond to that?
I mean, I think the thing that I had wanted to mention beforehand was also looking at the skills gap. So when we think about career pathways and the ability to actually have a job, retain it, but then move and progressively get to a career that can actually lead to a living wage job, there's also this this challenge with what skills do individuals need to get them to that next stage, and are the employers actually providing the skills necessary for that? So thinking about some of the work that we do, we have this program at LISC called Bridges to Career Opportunities, and the entire thing is really about how do you connect individuals who have a skills gap to high-paying jobs. I think that that's something that when you think about what jobs are current and what jobs are actually in the future as well, I don't know what the data statistic is, but I'm pretty sure that the majority of the jobs that people have now are not going to be in existence in 10, 15 years. So also thinking about what kind of training programs are put into place so that people are actually being prepared for the jobs of the future as well.
So, and just on the flip side of that, I fully agree with you. I think a lot of this conversation is about the wages, and that I argue that the wages have really not kept up to where people need to be. So, and this idea that the jobs of the future is a problem, I agree that there needs to be thoughtful conversations about what those jobs of the future are. However, the jobs of the future, some of them are still going to be taking care of people, right? So we know that especially in New England, where we have a growing senior population, we need caregivers to take care of those seniors. We also need caregivers to take care of our young children before they get to kindergarten. And if you look at those wages, they are way under where they need to be in terms of taking care of those workers' families themselves. So I really encourage that there be significant, and that is, I really am sort of fascinated by this caregiving wage conversation, because a lot of those jobs are partially funded by state budgets, right? And so how do you look at those jobs and what the impact is on both the state budget and the industry itself, and how do we impact those in a way that increases jobs over time? So I think that's one of those pieces, the important piece of this conversation as well.
So I think the only other thing I would add to that is if we think about how it is that people use their homes over time, in addition to paying for them and paying a mortgage and taxes and so forth. Historically, families have been able to build equity in their homes, partly because if you stay in a home for a long time, inflation over time actually creates more value in the home, and partly because you pay off your mortgage. It's that money that then gets the next generation teed up to go to school and to start their own lives. And I think a lot of what we've been seeing, particularly with respect to the reduction in value in homes, particularly in communities of color and in low-income communities, is that that cycle really got broken. And it's not so much that it's reestablished yet. In terms of the families we work with, we've been able to reduce their outstanding principal by about 30% and actually put them within reach of equity really from the moment they take on a new loan with us. And that's actually allowed people to build equity over time. But it's a small group, and I think that there are still lots of pockets around the country in which prices, as I say, particularly in communities of color, have not really come back. So when we think about, I think about housing and foreclosure and the creation of wealth through housing, not just as a momentary issue, but really as a generational issue. Because if we can't get that going, then we have another generation coming through that isn't going to be able to afford to go to school and isn't themselves going to be able to grab hold and try and reduce their levels of poverty.
I want to give one example, and this is in the city of Chicago, in the Woodlawn neighborhood near the University of Chicago, in which POA has been working for the past 10 years, in terms of the connection between housing and jobs and comprehensive services. So we worked on a comprehensive revitalization approach in Woodlawn, created about 1,000 units of mixed income housing. We brought in small businesses, commercial development. And most recently, a new Jewel Osco grocery store opened up in Woodlawn, first time in 40 years there's been a grocery store there. And we worked to place 376 low-income residents from Woodlawn in jobs in that grocery store. We also had about 80 of our own residents living in assisted housing obtain jobs in the grocery store. How did that happen? It was an intentional effort over a period of time where we linked up with neighborhood groups, worked closely with the employer to make that happen. I think we need more approaches. That's just one example. There's others around the country where affordable housing developers and owners need to think much more about workforce and jobs and how to move people up the economic ladder, because that not only helps the residents of low-income housing, it frees up a unit for the millions of families on the waiting list for affordable housing. We're not going to be able to produce enough affordable housing going forward. We have to look at how to serve more families. And one way to do that is through the economic mobility approach. So I just bring that up in terms of the jobs housing nexus that we've seen play out favorably in one neighborhood in Chicago.
Thank you. And does anyone else in the audience want to respond to the question about the relative merits of the two parts of the dual mandate?
David Lubroff from the Joint Center for Housing Studies at Harvard. This is actually more of a question. I was struck, a couple of the panelists talked a lot about the role of home ownership, which 5 years ago was probably a question that was off the table given the subprime mortgage crisis. So I'm wondering, do the panelists agree that we ought to be focusing on home ownership? And if so, where would you point the Fed, right? Low interest rates, I think as Aaron pointed out, are something that we think facilitates home ownership. But is that something that everyone agrees ought to be a policy goal? And if so, where do you think the Fed ought to be pointing?
Well, I absolutely think it ought to be a policy goal. I mean, home ownership is really the route in this country for people to achieve, essentially to jump class, right? They develop equity, their kids go to school, everybody does better. I mean, I can say my own grandfather came from Eastern Europe, about 14, with some carpentry skills, and became a pickup truck guy. And, and 2 generations later, I'm sitting here. So I think it is a classic story, and I think it's never changed for, all of the immigrant groups that have come over the centuries. So I think to say somehow that we are now going to stop that benefit really does a disservice to the generations that come after us. I think what's critical, though, is that people understand both the costs of homeownership over time and that we have some flexibility in terms of helping people get through their shorter term issues. One of the challenges of being low income is that employment is often not as stable as it can be for some other parts of the population. And so when we have mortgage products that simply require payment every single month, no matter what, for 360 months, it can be difficult. And I think if we can build into that some flexibility that allows, that reflects the instability in people's employment and allows them to stay in their home and to then work the problem back out again over a long period of time, that would be extremely helpful.
Okay. What's the Fed's role? That certainly for first-time home buyers and low and moderate income home ownership, keeping a strong Community Reinvestment Act would be one. And I know there's certainly discussions. Maybe that's for another forum, but I'll throw that in there on CRA. I think the Fed we need to focus on home ownership. We need good pre and post-purchase counseling. I'm not saying the Fed should fund that, but there's probably a role and there has been in the past in terms of high quality homeownership counseling that needs to continue and expand. Certainly down payment assistance programs are essential. And then in some of the weaker markets, covering the gap between the renovations and then the sales price through a public subsidy is also critical. And so I think that's also a neighborhood revitalization strategy at the same time where you're getting home ownership, but also neighborhood stability and revitalization. So those are some of the things. I don't know I can't think off the top of my head the specific Fed role, other than I think there's probably a research role and evaluation role there as well, but there's certainly CRA and there's financing of these properties.
I think I would just say briefly, anything the Fed can do to ensure that there is equal access to capital across populations. We know that in communities of color, the access is not as readily available as it is in white communities. And so making sure that access is as equal as possible, because certainly, yes, homeownership is the way to improve economic outcomes, but we know that in the last recession, it was our communities of color who lost their housing more significantly than white Americans, and so how do they have farther to make up in that, and so making sure that there's that equal access is an important piece of that.
I think the one thing that I would add, Tracy had mentioned earlier, it's not just about buying a home, but staying in the home and keeping your home. And during the recession, I remember, or a little bit after actually, when I was working in Mattapan, there were so many people that were misinformed. Like there were all of these kind of predatory folks knocking on doors. I don't know if you all have heard, there was like this keys for cash. Literally, there would be people coming in saying that somebody would offer them X amount of money if they would give them their keys in X amount of time. So any kind of role that the Fed could take around really advocacy and homeowner education, what happens after you actually buy your home, how do you maintain it, the need for a financial coach to really help you kind of think about, oh, your insurance raises up every year, and like, how did that happen? And all of the different kind of nuances that come with actually owning a home. Your boiler breaks $8,000, $9,000, $10,000, which is completely unexpected. That type of emergencies that people come into, it's not what you think about when you think about, oh, I want to buy a home, I want this kind of security for my family. So I would definitely say kind of like an advocacy role.
Wonderful, thank you. Okay, so we have a few more minutes, so we'll take your comments, sir, and then sorry, I didn't see you there.
Yeah, Tom Phillips. I have a consulting firm in Connecticut, and I was thinking about the unemployment rate, and in particular, comparison of the U3 versus the U6. But the U3 is what we hear publicly in terms of the unemployment rate. The U6 includes folks stop looking for work or they're part-time and would like to work full-time. And that adds about another 5% onto the unemployment rate. I think the Fed could help out to really break down what the U6 profile is. For example, we know in this country we have about 6 million 18 to 24-year-old opportunity youth who aren't working, aren't in school, they're disengaged. How do we tap into those different components? But we have to really understand the profile of who is in that U6 data. And I look on the demand side of the equation, and recently at a meeting, the CEO of Pratt Whitney Aircraft was asked, what keeps you up at night? And he says, 2/3 of my workforce is retiring within the next 10 years. And the system in Connecticut to produce the replacement workforce is putting out less than 100 graduates. So these are the kinds of things of, we have to understand the profile and then look at the demand side of the equation to make sure that we're responding to that customer as well. But I think that could be helpful.
Thank you for that. So does anyone on the panel want to respond to that? Or should we give this gentleman a chance to ask his question?
Yes, thank you very much. So the answer, I would like to say something that you said is that the access right into the type of capital and also the education. So we are inside of we are inside the neighborhoods, the schools every day, and it is even worse. So we was at this one thing, and a woman had said, well, I'm trying to pay for my kid inside what's school, and I have all these here with bills and debt. So I said to her, you own a home? And she said, yes. So I said, well, why don't you take out some of the equity out of your home and then pay for that type of the thing right there, debt. And she had kind of turned to me and said, what is equity? So there is the type of issue. So you get people see, money is a language, and when that you get into the neighborhoods right up in fact what's the color, we don't understand the language at all. So if that you don't understand the language, how can you know what is equity, what is anything, because we don't understand the language. And then the older that which you are, the type of less type of what the likely you are to infect and say, well, what is this? What is this? So people are not very, very much likely to even ask. I mean, I work with a bunch of the engineers who are really, really smart, and they are saying, but we don't know anything about how to open up our own company. And to say what that in fact, the guy over here said, we have ourselves 10 in fact, 1,000 people every day, turning the age of 65. So we are going to soon become either Norway, or we're going to become Germany, which we have this aging people, but we don't have anyone up behind them because of that lack of the education. And so I happen working with the people here at the Infector Bank, and I think the early education and having that the kids come here like I have. I've had kids in here, and we've done what programs and competitions, and that is great. And so what they have done is they have gone to educate that there were moms and also dads.
Thank you very much. And so we'll go ahead and end on that comment. And I want to thank all the panelists so much for spending your time and sharing your thoughts and asking your questions with us. So thank you very much, panelists.
Thanks, everybody. We've got some refreshments.